Right, so that's a view from Chola Securities. And now to make sense of this non-stop IT sell-off, we've got Sandip Agarwal of Sowilo, joining in once again. Sandip, morning, and thank you for joining us again. I know we're troubling you. I'm sure business media is constantly troubling you because you're someone who's seen these cycles before in your earlier avatar, right? Now, what did you make of this? One day it is SaaS companies, then suddenly now there's this panic that, okay, cybersecurity companies will have nothing left to do because Claude is doing everything. And tonight there is this Anthropic event, so God alone knows what more they'll announce. What have you made of everything that's happening in the US around AI?
Hi, good morning, Sylvia, and thanks for having me on the show. So, there are two different things. One, I think last year, 14, 15 months back, when I was negative on the sector, I was negative because I was saying that for a sector which will grow at 4, 5% in the large names and mid names, 8, 10%, the peg ratios were 5, 6, 8 times. So that was very, very scary stage. And I thought that, from here, at least 40-50% correction minimum on the index level is warranted because AI will take away at least 20-30% of the efforts over a period of 5 years. So every year you will have 4% decline in efforts, and you have to get at least 10% new business to even grow at 6%. And that was the reason I thought that, at index level, we should have a sharp correction of 45-50%. And I think large part of that has happened. Yesterday's blog and all those things, I think, honestly speaking, for the first time, I believe that this is a positive because no one was willing to even touch the old architecture, COBOL and all, and we have never taken that value even in our terminal valuation. Now, if Anthropic, what they put in the blog, and if they are really able to understand and they are able to streamline, I think up at least $1 trillion, 800 billion to $1 trillion opportunity will open up over next 10 years to streamline it, because every CTO wants to streamline. Challenge is everyone was worried whether it can be done in a rational amount of money and a rational amount of time. If AI can solve that, I think there is a very big opportunity for Indian IT and any services firm. So I first time in last 15 months feel little
And
positive with
you
this
and
news.
you remain okay. So you're saying, because you were very negative on IT, Sandeep, when we spoke earlier, and you had anyway sold off all IT stocks in your portfolio last year itself, but you're saying you're turning a little positive on Indian IT companies now.
So I would say that two of the large cap, like out of all the large cap, they have corrected meaningfully. I think I don't see much correction in them from here, because maybe 5-10% I will not be able to call that bottom. But yes, I have some problems with some of the mid caps because they are insanely expensive right now. Also, there I still think another 25-30%. So total correction which I expected in the large name was 40%, 45%, and in the mid names I was expecting 65-70%. So large have corrected by 35-38%. So there is another 5-7-10%. I don't know where it is bottom. Mid cap, some of the names are still, I think, will correct by 25-30%. But broadly, I think the elephant is gone. The last, tail is left. So I am not so negative. I think, our business model is not such that we will see revenue declines. We will see low growth for long term. That is true, but not, a decline or something. So I am more constructive on IT services than the software piece. And I believe incrementally with little more correction, which can happen in next few days, I think, it will become very attractive.
Oh, interesting, interesting. I'm going to come back and have some more questions on that. So I think everything is good at a certain price. The question is, what is
Right.
that price, right? That's the way the market functions. When you're talking about good companies, with good corporate governance, with big war chests, with cash. So since all of IT ticks all of those boxes, the question is how to deal with this technology disruption. So I'm just coming back, Sandeep. Markets opened. Allow me a couple of minutes. Okay, we've got a 100-point drop as the market has been trying to find its feet. Let's look at what's going on. So 110, 105, that's what the Nifty is doing, at least for the time being. The Bank Nifty is absolutely flat. The mid-cap index is down about 0.3% as well. Let's straight away fire up the Nifty losers, and you will find IT names on that list. So Infosys is down 2.5%, HCL Tech is down 2.5%, TCS, Tech Mahindra, Wipro. It's the first blow, really. I mean, when you wake up to US IT stocks and US cybersecurity stocks down 9, 10, 11, 12%, when you wake up to IBM crashing 13%, then the first cut will always be red. And that's what's playing out. The question is, do the buyers come in? Because IT stocks were down yesterday. And I mean, look at this. A stock like Infosys is down 20% this year. HCL Tech is down 14% this year. TCS is down 18% this year. So the question is, at what price do you start hunting for some value? And that's the big debate raging on the street right now. Right now, it's still negative. Beyond IT, Eternal is facing a lot of pressure. Eternal is down 2.5% again, so watch for this one. Bajaj Finance, Bajaj Auto, Trent, BEL, Mahindra and Mahindra, Shriram Finance. That's a lot of red on the Nifty beyond IT as well. So unlike yesterday, where IT was really the only part that was lower, this morning we're seeing a more broad-based weakness. And financials are not providing the kind of support that the bulls would have hoped for. You can see names like Shriram Finance also lower, Bajaj Finance I mentioned. All of these stocks are down on the Nifty. Right now I'm still on Nifty names. You can see Midcap IT also down there, LTI Mindtree, Coforge. All of IT is down, so that's IT. But let's just come back to the Nifty for the time being, because the problem with the Nifty is not only IT today. Other stocks are also lower. And that's what's bringing up this 140-point decline. Titan, ITC, FMCG consumer names not really working. Reliance is down about 0.3% as well. ICICI Bank is lower. So financials are not providing the kind of support. Consumers are not providing the kind of supports. Auto itself is lower. So you don't have any batsmen holding up the other end. That's the problem. In fact, speaking of the other end, let's now pull up the Nifty gainers. Here, a couple of metal and commodity stocks come up on the screen. ONGC, because oil prices are still elevated. There's still a lot of uncertainty with what's happening in Iran. So about 1% higher on ONGC. Then there's Tata Steel, NTPC Power Grid from the power space, Coal India, JSW Steel. So largely power and commodities. That's what's up. Otherwise, the Nifty is having a bit of a tough start. Okay, now I'm looking at some of the mid-cap losers as well, and we were flashing those stocks, so let's come back to mid-cap losers. Persistent, Coforge, a lot of these names, L&T Technology Services, all of them are down. And then you have some financial names here as well. M&M Financial, for instance, is lower. Hexaware is down to 2.5%. Schneider Electric, Physics Wala, lots of names on the losing end of the screen. Let's see what's moving down on big volumes. Eternal definitely stands out. Trident, Lemon Tree Hotels, Bank of India, Railtel, quite a few PSU stocks also out of favor today. Okay, is there anything on mid-cap gainers? Anything worth highlighting? HEG slightly higher, Jindal Stainless. So again, it's metals, commodities, materials. That's where you're seeing some little bit of a green. But otherwise, it's a pretty, cautious start to trade, one would have to say. Watch for one MobiKwik. Remember, we told you when we were outlining our stocks and news today that it has received the license to start its stockbroking business. And one MobiKwik is rallying away, 9% up on one MobiKwik as it gets set to launch its stockbroking business. So we'll just pull up that stock. Those are the other mid-cap gainers, but one MobiKwik is the one that we should pull out. IDFC First, trying to recover, about 0.5% up. AU Small Finance Bank, about 0.5% up. That's the stock of the morning, really. On the gaining side of the screen, big move there, 11% and counting. So that's pretty much how the market is. And the Nifty is down about 140 points at this juncture. Okay. So Sandeep, coming back to just complete that argument that you were making, you're saying that at some point now, between here and maybe another 2-3 weeks, we're close to the bottom. Maybe this is not the bottom, but we're close to the bottom. Then the most critical question, what kind of Indian IT companies do you think will weather this storm? Do you think will be able to make that transition, make that pivot? So what kind of IT players? Large, mid, small? Give us, I know you won't talk stocks, but some clues, because you've studied these companies, these managements so closely in the past. Who do you think will manage to survive and thrive?
So Surabhi, I am very clear that, none of Indian IT services companies has any business model problem the way the US companies has. So I think, biggest destruction from the business model perspective or 0-1 will happen in the US, primarily in the software side, cybersecurity side, all those companies, and they are going to fall very, very sharply. I feel a lot of those names are massively overvalued on the PEG ratio side. In fact, some of them are, the PEG ratios don't even exist because the growth will fall very sharply. But Indian IT will not have those challenges. As I said, we will have 20% deflation over 5-6 years. So 4-5% deflation a year, and we will get at least 7-8% new business. We will be 2-3% growth. But the problem is that, lower growth for longer. So, for 5-6% growth for 5-6 years, you cannot pay, 20 times multiple, 25 times multiple for the large names. You have some rupee benefit which is happening. So, maybe 15, 16 times, 14 times, 12 times is something where, you will start looking at them as a great opportunity. So I believe that, large cap between 10 to 15 times is where I will definitely be interested. And I think we are getting close to that. Mid cap, I would be very comfortable, at 18 to 22 times, and not like, 30, 35 times, which they are, some of them are still there. So I am very confident of the business model, zero negative, my view on that. But lower growth for longer. So PEG ratios has to be justified to make money. I won't go, more than 2 times PEG ratio, 1.8 times PEG ratio for large names, and more than 2.5, 2.2 times PEG ratio for the mid cap. And I think we are getting closer to that. Some of the mid cap in ER&D space are extremely expensive. I think there is another 20-25% correction, which is imminent there. But rest of the names are not so bad. And I cannot call out the last 5-10%, but I think in large cap 5-7% more correction, and mid cap 8-10% more correction, barring some of the ER&D plays. And I think we will make the bottom, and from there it will look, everything will look more reasonable and more realistic. And I'm telling you, you will not be surprised on negative growth for sure. I can assure you that much. I don't see any of the tech companies will have a negative slide of revenue and all that. I don't think we have that kind of business model at all.
Yeah, because I mean, the way the fall happened, it almost seemed to suggest that everybody's going to cancel contracts, saying, "Oh, we don't need Infosys anymore. We don't need TCS. ChatGPT will do the job, and Claude will do the job for us," right? So that's not happening, you're saying.
No, it will not happen. I have seen this industry for 25 years, and every time when disruption comes, it is more painful than this. Uh, uh, Only challenge which I see in the sector, something should not happen on the execution side from, the client market, some kind of regulation comes. Those things we are not still building in the risk. Like, you don't allow execution, you make, some kind of charges, some kind of taxes on these things. Then, that is not built in my opinion. In my opinion, today what is built in is lower growth for longer, so lower multiple for longer. So I am more of PE rating, which has also happened 80% of what I expected. Another 10-20% PE rating can still happen from here. So that is broadly my view. I am not at all negative on job losses and all those things. I think new job creation will be lesser, but not worried about job losses. Also, I think mid-level will have to reskill. Good part is lot of tech platforms are absorbing lot of mid-layer people. So, you are not seeing any big, hue and cry on the mid-level job losses also as of now.
Yeah, I mean, we live in hope and faith, and you're right. There will be a pivot, there will be a transition, and then you have that's a great point that there are platform companies as well. I mean, people who are well skilled in IT, they'll find a way, because that platform economy business, the internet economy business, is our own model. We've not discovered the LLMs, but we've got the whole gig economy. Everything is coming on mobile. We've got payments. So there's other formats of technology that India has kind of pioneered and adopted very well. So hopefully there'll be a place for all kinds of skill sets. Great conversation as always, Sandip, and thank you so much for joining us once again. We live in turbulent times, and it's great to have you to give us some perspective and to shine a light when things are so confusing. Thanks for joining, and I'm sure we'll connect again. Let's see what Anthropic is coming out with tonight, and I'm sure in the next couple of days we'll have more conversations about the next stage of the disruption. Thank you. Thank you so much. You have a great day. Thanks. Okay. So just a word on the street before we